What do the years 1999, 2021, and 2025 all have in common? Well, it's the only time in history that the S&P 500 has traded at an inflationary adjusted price to earnings multiple of 37 times earnings. And the last time this happened in 1999 and 2021, the markets then went on to have their respective crashes, which exceeded 40% in 1999 and exceeded 20% in 2021. So will 2025 see the same fate? Well, today we're going to discuss current market valuations, what's driving them, the risks that are present right now, along with one thing to remember when you're investing into the stock market. But before we get this video started, this video is for educational purposes only, and nothing within this video should be construed as financial advice. Nothing that I share within this video is any kind of investment recommendation, and be sure to always go and do your own research before you go on to make an investment decision. When investing, one of the common metrics used to determine the value of either a company or an index is called the price to earnings ratio. It's the price that investors are prepared to pay for every pound in earnings that a company or an index generates. Or in the context of the US stock market, that figure is obviously denominated in dollars. And right now, for every $1 the S&P 500 generates as a collection of 500 companies in the United States of America, investors are currently prepared to pay $38. A 38 times premium, some may say. But what exactly does that mean? Well, let's think about it like a simplified version of a Netflix subscription, where you have two different options available. Option 1 is to pay $10 a month and you get 10 new Netflix shows. Option 2, on the other hand, is to pay $20 a month, which also offers the same 10 new Netflix shows, making option B twice as expensive as option 1 on a per show basis. But with option B, let's say the shows are in 4K and you don't see any advertisements. You then have the choice as to whether you're prepared to pay that premium for option B, and whether it's kind of fairly priced and good value for money in comparison to option A. In a very simplistic way, the price to earnings multiple very much works the same. In the context, it's the perceived value that an investor has of that stock or the index, and perceived value is different for every individual investor. But who's to say what the right price to earnings ratio should be? Well, let's talk some numbers. Since 1871, so from 150 years of market data, the S&P 500 has an average inflationary adjusted price to earnings multiple of just over 17 times earnings, meaning that at some point in the past, investors have had the opportunity to buy into the US stock market at half the premiums that investors are prepared to pay today. But to contextualize this, we've not actually had the opportunity to buy into the S&P 500 at these average price multiples since about 2008, 2009, when the market actually collapsed about 50%. And if you said, well, I'm not going to buy into the S&P 500 because I believe it's overvalued based on current price to earnings multiples, well, you would have missed out on some 485% worth of market gains since mid-2009. I guess what I'm trying to say here is that valuations are certainly important, but they're not the be-all and end-all in terms of what's going to dictate future market growth or not. And that's even when those valuations are higher than average. But I guess the question does still remain, what exactly happens when valuations do become too high? The market becomes overheated and perhaps somewhat unsustainable at current levels, just like we saw back in 1999. And that was at a time when the inflationary adjusted PE was 44 times earnings. It was this point in time where perceived future earnings were just so high because of this new tech boom driven by the internet revolution. Yet unfortunately, those earnings never really materialized in the time frame that investors expected. Pet.com was a prime example. Led by their dog puppet advertisements, it was a company that raised $82.5 million from their IPO, listing at $11 per share. But then within 9 months of going public, they went spectacularly out of business thanks to rising costs and lackluster revenue. And as a result, investors lost millions. And there were many other companies that saw a similar fate during that period of time. But there is another thing here that the years 1999, 2021, and 2025 all have in common, and I've kind of already given a little bit of a hint. That one commonality that I think we can all agree on is that investors have pinned their hopes of the future of technology.
AI breakthrough has leapfrogged the world.
Artificial intelligence, this new techie word that's made its way into the mainstream media, and it's where many companies are investing millions and millions of dollars. According to one of the finest bits of artificial intelligence, which I use to pretty much help me run my business day by day, ChatGPT, AI is the simulation of human intelligence in machines, enabling them to learn, reason, and solve problems autonomously. It's designed to create efficiency through automation, cost reduction, improved decision making via data analysis, enhanced customer experiences with personalization, innovation in products and services, and competitive advantages through predictive analysis and market insights. Lots of arty-farty corporate words which are, in summary, pretty good for business. So no wonder it's one of the factors driving market performance and also driving those market valuations higher too. It's something that's believed to have so many benefits that Keir Starmer has recently set out a blueprint to turbocharge AI in the UK. So it's a big thing that both governments and companies are all interested in order to create additional commercial value. But through the lens of an investor, all of that creates expectation. That expectation to realize that future commercial value, whether that's through increased revenue, perhaps even decreased costs, increased profit margins, and increased profitability on the whole. And a lot of that expectation is being put on just 7 companies. Those 7 companies being the Magnificent Seven in the form of Apple, Microsoft, Nvidia, Meta, Tesla, Alphabet, and Amazon. The reason for that is because those 7 companies also make up about 30% of the current weighting of the S&P 500 index. And as a result, the S&P 500 is fairly reliant on these 7 companies and their future performance. And as a result, it provides quite the concentration risk for the S&P 500. If we relay this back to the current price to earnings multiples of these 7 companies as of right now, and then compare them to the forward price to earnings multiple, which is essentially an expectation for 12 months into the future, you can see that investors are expecting all of these stocks to trade at better value than they are today. The issue though is, what if these 7 companies don't perform? What if they're not able to create that commercial value driven by the artificial intelligence investment and development that they're all focused on right now? So let's discuss some more of the risks here, because whilst artificial intelligence may just be one of the biggest opportunities for these 7 companies, they could also be the biggest threat to their dominance too. Now, in order to achieve those forward price to earnings multiples that I've just presented, simplistically, there are only really 2 ways that those P multiples can be achieved based on the relationship between price and earnings. Either stock prices have to go down, or the earnings a company generates has to go up, or somewhat of a combination of the 2. Now that's all fine, right? Assuming Wall Street analysts are right and all of this investment in artificial intelligence does create some form of commercial value at some point in the future, and therefore adds additional revenue streams perhaps, and even potentially adds additional levels of profitability to those businesses. But there is also a risk that it could just be something that continues to hemorrhage through cash, leaving these companies exposed to something newer and better coming on the scene.
Technology shares on Wall Street have fallen sharply in response to the emergence of a low-cost chatbot, a chatbot launched by the Chinese firm DeepSeek.
A brand new application called DeepSeek has just launched a free open source large language model in late December, claiming it was developed in just under 2 months for less than $6 million. That obviously raised concerns in the stock market, especially considering that big tech are actually lining up $300 billion in AI spend for 2025. And that's $300 billion with a B. This concern caused Nvidia's stock price to crater some 17% because of this new piece of technology that had been launched to the market for a fraction of the cost. So with these risks present, it certainly shows us that no stock is kind of too big to fail, if you like, and that every stock is certainly vulnerable, especially if something new, better, cheaper, and more profitable comes along. Now that's just part and parcel of a business life cycle and doesn't really have anything to do with being an investor, although it is important for an investor to understand this, because companies do come and go over time. The top companies back in 1999 are different from the top companies that we see in 2025. Then when you add in the concentration risk from these 7 companies because of the market value that they have, just mathematically speaking, it could have a large influence on the overall performance of the market if one or many companies come out of nowhere and start to strip away that market value. That's one factor, but another risk factor to consider is when valuations are high, future performance might not be as good as it was before. And I do emphasize the word might here because, of course, past performance isn't necessarily indicative of future results. But as Mark Twain once said, history never repeats itself, but it does often rhyme. And it'll be interesting to see what tune the stock market plays in the short term based on the current valuations as they stand right now. What that tune will be exactly, I nor anybody else can tell you. But we can look at some past research to help educate us on some of the possibilities in order to remain somewhat objective. There was a piece of research released by JP Morgan Asset Management in this article which I found called On Bubble Watch, which I'll leave a link to down in the description below. The analysis showed the relative 10-year performance of the S&P 500 based on what the P valuation was during 324 monthly observations between 1988 and 2014. And the graph clearly shows a correlation between the higher price to earnings multiple resulting in a lower 10-year return. With where we are right now in the 27-year period at similar multiples today, the following 10-year period saw 10-year returns of between +2 and -2%, which I guess is a lot lower than what investors have come to expect in most recent years. But one thing that is important to remember is just because one piece of data says something about the past performance of the market based on valuations or whatever the piece of data is that you're looking at, doesn't necessarily mean that it's going to carry through to the future. And actually, Warren Buffett said in his 1999 Fortune magazine article that valuing the market has nothing to do with where it's going to go next week or next month or next year. The fact is that markets behave in many ways, sometimes for a very long stretch of time, that are not linked to value. Sooner or later though, value counts. And if you haven't read this article before, well, I certainly recommend that you do so. It's full of timeless wisdom for an article that's like 25 years old. But it's true though that nobody really knows what's going to happen in the stock market at any point in time, regardless of how much financial modeling that you go on to do. It's impossible to predict, so I nor anybody else should really even bother trying. Now, there are many other risk factors to consider. We've only really touched upon a couple of them during this video, so be sure to go away and do some further research on that and what actually causes the stock market to fluctuate in value. But before you go, if you want to know how I'm navigating my personal investment plans for 2025, well, be sure to check out this video next. But before you go, be sure to subscribe to the channel whilst you're here. With that being said, I'll see you over in the next one.